Today I'll be discussing just how far the S&P can go after the explosive move from the lows. We'll look at short-term charts, long-term charts, and at the end of the video, we're going to be looking at one eye-popping comparison that you won't want to miss. So let's start with the short term. And we've shown this chart many times. It's a 2-hour chart, the S&P 500 and the 14-period RSI on the bottom. And as we can tell, we finally got an overbought reading on this very short-term indicator. Now, some people may be saying, well, it took a while for that to occur. I mean, the S&P is up basically 20% from the low. Why did it take that long? It's not that the rally has lacked strength. That's, of course, not the case. It's that we had rallied from an extremely oversold level, right? It's just down to around 13 or 14 at the lows in the middle of April 7th, the big pivot day. And that was the worst reading since the depth of the COVID crash in March 2020. So it just took a while to get back there. Now, it's not like we're waiting for an overbought reading to occur, because along the way, as a review and as we've talked about before, we've seen bullish patterns in motion now for a number of weeks, and that's the most important thing. Of course, now they're starting to work across the board. But at the same time, it was important to finally get that, because we know during the best part of this rally over the past 2 years, we routinely saw the short-term RSI hit overbought readings. And now, on occasion, the pullbacks that we saw afterward produced oversold conditions as well, but those are temporary. So the best case scenario, of course, is that after this explosive move, after this really strong advance from the low, that you get back to a more calmer and more trustworthy uptrend. And as we know, that has a tendency to see ebb and flows as well, whether that results in a long-term trading channel like we saw before or something else. But as we can see here, having the S&P continue to make higher highs and higher lows and continuously see short-term overbought readings, that is the best case scenario from here. Now, here's the same chart looking at this from a drawdown perspective. And as we can tell, we get two extreme pullbacks along the way, separated by this, which ended up being a bearish flag pattern, but of course, very extreme. And so not surprisingly, once more, we got that RSI at 13. And so along the way, we just have to assume, even if the market ends up making new highs, there's going to be pullbacks once more. So again, we have bullish patterns in motion. We want to see more of them. It's okay to be greedy, meaning that they'll develop on a short-term basis first, and once they start to work out, we know those can build the foundations for much bigger ones. And so not surprising at any point to see some more profit taking. Haven't really seen too much of a pullback at all, right, over the last few weeks. But once it comes, even if it undercuts some of the short-term support levels that we're looking at, it still has the ability to form a higher low at some point. And this is the luxury of rallying so far right now. Of course, it's made a lot of people a good amount of money on the rebound, but from a structural standpoint, it's created a big cushion for the S&P now to pull back to and form some sort of higher low and continue from there. So now zooming out, we'll look at the biggest rallies going back to the beginning of 2022. And as we know, there are some strong multi-week bear market rallies in 2022. A lot of them fell near the 200-day moving average. That's important to recognize, because the current one, again, measuring on an intraday basis, is over 20% now. And that is one of the biggest, clearly, over the last number of years. It's approaching levels that we saw from the March low in 2023 to the July high, and then again from the October low, the low in October 23, to the high in late March of that year. Now, as we can tell, each one of these that extended to 20% or more started with the S&P 500 below its 200-day moving average. Now, there are clear differences to the past two compared to now, because we know the S&P was only marginally below the very important long-term moving average, and spending the majority of that rally, the majority of that 20% gain each time above the line, which is extremely different from right now, where we needed that big advance on Monday, May 12th of over 3% to officially get back above it. So they made a lot of headlines, and of course we want to see it stay like that. But again, this rubber band now so stretched to the upside, it wouldn't be a surprise to see that 200-day moving average undercut once more. Now, it's not going to be the end of the world if it does, but if in fact that does happen, we're going to hear a lot about how it failed back in 2022 numerous times before it eventually went above that. And we reviewed that as well. But the more this market has come back and the stronger it has been, it looks a lot less like 2022. Now, could everything just fall apart and we'd be falling to a bear market like we did back then on a very long-term basis? Of course, but we kept on comparing it to failed rallies back then. But when you typically would see a lot more selling come back in the picture, that hasn't happened just yet. So that's important to recognize as well. And so in terms of 1% declines, guess what? We still haven't seen any. We're running at now 15 straight trading sessions without a 1% decline. We reviewed this last week. We're at 10. Of course, that's now continued. So we're fast approaching the longest run of 2025, which is 17, which again, we're not close to the longest span we saw in 2024, which was 52, again, which really nailed the best part of the move last year from that early May low to the July high. It's not a necessity to have this streak continue because it could end in 1 or 2 days. It's what the market does in reaction to that, because it's a very easy concept. The fewer 1% declines that we have, the better the market is. And so that was something we were hoping to see, of course, on the way down, and now what we are seeing on the way back up. And so we've had a number of 1% gains since that point. As we can tell, 5 of them since the last 1% decline on April 21st. At the same time, there's only been 2 gains of at least 1% in the last 12 trading days. And really most of the price action has been relatively calm with just 2 big days along the way. And think about best case scenario, that's what you want to see. It really means that you're consolidating for a bit. Then you have a breakout, you digest that, which ends up being like a staircase-like advance where trading boxes start to work once more and bullish patterns start to be leveraged. We're starting to see that over the last few weeks. So quite simply, you want to see something like that continue for this market to turn from this locomotive type movement to something more trustworthy and would have some more longevity as well. So if you're enjoying this video and want to see more content like this, check out CappThesis.com, where we go way beyond the S&P 500, look at various asset classes, crypto, international stocks, commodities, FX, bonds, so forth and so on, all to come up with a market stance to help us pick the right trades, which we provide multiple times a week to our premium subscribers. You check out the various membership levels and see which one is right for you. Now back to the video. So one indicator that we love to look at across all different market environments, because it's very telling no matter if it's successful or not, is the MACD indicator. And so one way to see that is noting that we finally got a buy signal that worked, and obviously very well because it was triggered a few days after the low. Of course, it didn't nail the low because you need to see some sort of reversal or price flip after excessive downside momentum for that to occur, but finally did. And it's, in hindsight, it seems pretty obvious at this point, but remember, this is coming after 2 failed buy signals that we saw in January and then again in March. And the last time that we had seen 2 failed buy signals within the MACD was during the correction from August to October 2023. Head fake, and we finally got one that worked. We know now that it nailed a huge turning point, which then led to numerous months of upside action, which really lasted until just a few months ago in February. So as we can tell, it's interesting and it looks quite similar in terms of a pullback, which finally encouraged traders to go back into the system. And now we know it's been historic for numerous reasons, because of the volatility, because of the reasons behind it. But from a price action perspective, we can see how then this could develop into something more substantial once more. The next phase would be to make new highs and continue higher from there in a more consistent basis. So it's going to be important to see once the next selling opportunity happens, next time the S&P starts to fade and potentially build some sort of topping formation, if that results in not only a MACD sell signal, but one that actually works. Because we recall in 2022 and early 2023, both MACD buy and sell signals worked well, meaning that you had this back and forth movement as the market was moving lower during the thick of the 2022 bear market, but also afterward, meaning that you couldn't really trust breakouts along the way because they all reversed. And so we can see that here, all the blue lines showing the times when we had a MACD buy signal, right? The lines crossing from below the zero line, and then MACD sell signals in red, quite easy to see. That just meant it was a trading environment where mean reverting indicators like the MACD and others worked well, where buying breakouts did not. And so right now we have, as we'll review in a second, a number of bullish patterns in play for the S&P 500 in numerous other areas. And so some of those short-term targets have been achieved already. That's a good sign. But now we need to see bigger formations play out as well. So let's get into that now with the patterns. And so we finally had an upside target hit. 5840 was hit toward the end of the day on Monday, May 12th, as the market was extending higher and closing near the highs. And we saw that here in the 60-minute chart. We've been talking about it ever since the breakout happened a few weeks ago. And what does that mean? Well, it's the first successful bullish pattern of 2025 after having 3 straight fail from early December through the end of February. We reviewed that along the way, showing that there were cracks in the system because prior to that, we had 11 straight successful bullish patterns. Some very big, some small, but that just kept us on the right side of the trend because, as we know, bullish patterns working is one of the key components for an uptrend to extend the way that we saw over the last 2 years. So this is step one. Now, once more, we don't wait for a target to get hit to get bullish, but when you start seeing bullish patterns work, breakout zones respected, that's when you can get bullish, and which of course we have been doing over the last number of weeks. So that's number one. Number two, the one we reviewed last week, we also have a much bigger target of 6125, and that came with a breakout just a day after the last one. And it was tested immediately a few times over the ensuing few days, and now with the extension from that point, we're now a good deal away from that breakout zone, which of course is good, and it was something that we saw over and over again in 2023 and 2024. And as we can tell, that's very close to the former highs. And because the price action on May 12th was so strong, a much bigger inverse head and shoulders pattern got triggered, which produced a target all the way up near 6,500, right? So a good deal higher than the prior high. So you get this question all the time. How long will it take to achieve that target? And how confident are you that's going to be achieved? Number one, I have no idea. Number two, I have zero confidence that this is going to work. Now, what does that mean? Anytime there's a breakout, of course you respect it. But if this gets faded immediately, then it's negated. And at that point, it's no longer in play. Again, we saw that 3 straight times from December. And the biggest one really right near the highs, we had that breakout, there was a 6,400 target thereabouts in February, and that got nullified. And with that being the third one failing near the highs, that's what got us concerned that things were changing. So now the reverses happened right now, right? We finally see the beginning stages of these forming, whether they're smaller or bigger ones like this. So as long as this breakout zone holds, and it's only a day or two in, then that upside target will be intact. Remember, when we got that breakout through 4,800 in January 2024, it produced a 6,100 target, which stayed with us 11 months later. And so what gave us confidence along the way to get to that point was that many other smaller bullish breakouts were working. And the more that happened, the further the S&P extended from that breakout zone, and the higher the probability that target was going to be hit. That's going to be the same thing with this current 55 target and any other larger upside objective that gets registered along the way. And so let's not forget how this occurred, right? We saw bearish patterns work on the way down. Again, very helpful to see that regardless of the news. And then the turn, and then we saw beginning stages of bullish patterns form on the way up. And remember, initially it wasn't clear because a few of them were messing. It didn't really work, especially considering that huge volatility week. But from that point, things have settled down a bit. And as we just reviewed, there are fewer 1% declines sprinkled in with a good 1% gains. This is what produces this type of foundation potentially going forward. So as it stands now, we have one bullish pattern achieved, and we have the two we just reviewed as live with no bearish patterns. Last time we had a bearish pattern in play was when the market was falling apart in early April. Got the last bearish flag objective hit on April 7th. At that point, it was over and we're waiting for the next one to form. So far, it hasn't. So we'll be on the lookout for next time the market fades or starts to digest things and potentially form a top. And that's when we'll see how well the market can withstand that. And so let's not forget, we got an idea what this could be like when we talked about how the S&P was getting close to 5,500, right? And it looked like, again, potential brick wall was right in front of us because of where the market broke down from. But as we reviewed at the time, we had a very similar scenario in 2018-19. It happened to come with the tariffs as well, but we're more concerned of what the price action and the patterns look like along the way. And we noted that this was a bullish pattern, a cup and handle pattern, which eventually got its target hit and it led to an extension that lasted, of course, until right before the COVID crash. So far, similar and now even stronger, right? Cup and handle pattern, and we get, again, other shorter term versions in there as well. You're getting close to the highs once more. And the further you get up there, again, the more breathing room you have to back and fill and build bigger patterns. But this is not the comparison we're talking about. The eye-opening comparison that we want to make sure everyone sees is this. The XLK Technology ETF, as we know, come back extremely well, right? This is up about 28% in 6 weeks, which is an extreme bounce back, especially after falling 30% along the way. And so we have to go all the way back to, not surprisingly, 2020. This is the last time that occurred, but look how similar this looks. So last time you saw a 6-week advance of at least 20% was in May 2020. Again, off of the lows. XLK was getting very close to its former highs from just a few months before. And once it got there, as we know by now, kept on going to eventual advance of over 160% by the time late 2021, 2022 arrived. So we're up now even more than that off the lows, approaching the highs. Again, is there a possibility that XLK continues to lead and blast through those highs and continues much, much higher? Right? I don't think anyone has that as a possibility, but again, we can't ignore any potential, especially when we have momentum like this. And even when we got back to new highs back here, it wasn't easy, right, along the way, because there were some pullbacks, pretty meaty ones in the following months. But because we track patterns so closely, we recognize the fact that none of those potential tops ended up playing out. And when the bid came back in, that's when, of course, you saw bullish patterns start to work again, break out to new highs, so forth and so on. So going forward, we're looking at the S&P and XLK and identifying where the next bearish pattern is. And if they continue to fail, then we know the buyers still care. If you want to see how this played out very well last year, check out this video where we talk all about it.